Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Marvell Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath, so we all know the standard artificial intelligence story by now.
Right, everyone watching the markets is completely fixated on the compute layer.
Exactly, the compute layer. We look at the graphics processing units, the processors that act as the brains of the operation, and we track who is building the smartest, fastest models. But if you look closely at where the foundational capital is actually flowing right now, it isn't just going to the compute layer anymore. It's flowing heavily into the interconnects.
The superhighways.
Yeah, the superhighways. Today, we're looking at the superhighways.
I mean, that is the perfect way to frame it. This is the infrastructure play.
Yeah.
Because you can have the absolute most advanced, sophisticated processing unit on the planet. But if the information cannot move through the physical server racks fast enough,
You hit a wall.
exactly, you hit a structural wall and the entire operation stalls. So Marvell's technology is essentially building the high-speed toll roads for this historic data center upgrade cycle.
Which is huge for anyone listening right now.
It really is. Today, our goal is to unpack their recent growth numbers, dig into some confusing geopolitical turbulence that has been dragging down their stock price, and ultimately figure out if this current dip we are seeing is the right entry point for your wealth building strategy.
Spot on. So for you listening, whether you are actively managing a growth portfolio or just trying to understand where the institutional money is quietly positioning itself in the tech sector, this is a really crucial conversation. Let's start with the top line.
Let's do it.
We have their Q3 fiscal year 2026 numbers in front of us, and they are genuinely eye-catching. Net revenue hit $2.075 billion.
Nope.
That is a 37% jump year over year. I mean, what exactly is driving a multi-billion-dollar hardware company to grow by nearly 40% in a single 12-month period?
Well, the engine behind that growth is almost entirely their data center segment. If we break down that $2.075 billion in net revenue, roughly $1.5 billion of it came directly from the data center.
Wow, okay.
Yeah, so that means 73% of their total revenue is
Yeah.
now concentrated in the exact sector experiencing this unprecedented capital expenditure boom. That specific data center segment grew by 38% year over year.
38%.
It is massive.
Hmm.
And it's being driven strictly by demand for custom AI silicon and optical interconnects. And what is particularly compelling for anyone building a long-term investment position is the forward guidance.
Right.
Management just raised their data center growth forecast for fiscal 2027 to over 25%.
Which is a remarkable trajectory when you consider the base they're already operating from. They're aiming for a total projected revenue of $10 billion in fiscal 2027. But I want to pause here. I want to push back on something in these financials because the profitability metrics stand out to me. Marvell posted a non-GAAP gross margin of 59.7% in Q3.
That's right.
Almost 60%. That sounds like a software subscription margin, not a hardware manufacturing margin. Is that actually sustainable in the physical tech space, or is this just a temporary spike because we're in the middle of an AI gold rush?
It's a fair question.
And while we're at it, what exactly are they stripping out of their accounting to get that non-GAAP number?
Those are essential questions for anyone evaluating the health of this business. Let's tackle the accounting first. When a company reports a non-GAAP margin, they are pulling out certain non-cash or one-time expenses to give you a clearer picture of their core operational cash flow.
Okay.
In the tech sector, this almost always means stripping out stock-based compensation for their employees and the amortization of intangible assets from past acquisitions. It gives investors a cleaner look at the actual cash generated by selling their products.
Okay, that makes sense. It shows us the underlying profitability of the actual chips and cables they are selling.
Precisely.
But what about the sustainability of that nearly 60% figure?
It is highly sustainable, precisely because of the complexity of what they build. This isn't commoditized hardware where you compete in a race to the bottom on price.
Right, it's not just generic cables.
No, this is highly customized proprietary silicon. When you offer a product that solves a critical bottleneck and has extensive intellectual property protecting it, you command immense pricing power. That near 60% margin means that for every dollar they bring in, they're keeping a substantial portion as free cash flow.
And cash is king.
Always. They use that hard cash to aggressively reinvest in research, buy out emerging competitors, or return capital to shareholders. It proves their customers deeply value the technology.
Let's talk about that technology then. To understand their competitive moat, you really have to understand what they're selling. But I want to do this without getting lost in engineering textbooks.
We'll keep it accessible.
Essentially, Marvell provides customizable AI silicon and hyperfast connectivity. For example, they produce 1.6 terabit optical solutions.
Yeah.
Now, to someone managing a retirement account, 1.6 terabit optical sounds incredibly abstract. What does that actually mean in practice? And why are companies like Amazon and Microsoft clamoring for it?
Think of a modern AI data center as tens of thousands of extremely powerful computers that must talk to each other simultaneously to solve a single complex equation.
Okay.
The two most severe bottlenecks in the world right now for hyperscale companies are power efficiency and data bandwidth. Moving electronic data over traditional copper wires generates a tremendous amount of heat,
And uses a ton of electricity.
vast quantities of electricity. Furthermore, copper simply cannot carry data fast enough to keep up with modern processors. Marvell's optical solutions solve this by moving data using light instead of electricity over fiber optic cables. It is exponentially faster, and it requires a fraction of the power.
So they're replacing electrical signals with light signals to cut down on heat and speed up the communication between servers.
Precisely. And that technological advantage is why they have secured 18 distinct design wins with hyperscalers. When we say hyperscaler, we are talking about the absolute titans of cloud computing, Amazon, Microsoft, and the like.
Let me stop you there, because the phrase design win gets thrown around in tech analysis a lot. What does that actually mean for the balance sheet? Is that just a fancy way of saying a tech giant signed a purchase order for some cables?
It is much deeper and much more lucrative than a standard purchase order. A design win means a company like Microsoft has chosen Marvell's specific custom architecture to be physically integrated into the blueprint of their upcoming data centers.
So it's baked in.
Completely baked in. They're building their multi-billion-dollar facilities around Marvell's specifications.
Okay, so if Microsoft wakes up tomorrow and decides they want to use a competitor instead, how hard is it for them to switch? Are we talking about a quick software update, or are they literally ripping out physical infrastructure?
They would be ripping out physical infrastructure, redesigning their server racks, and rewriting the software that manages the hardware interactions. The switching costs are astronomically high.
So they're locked in.
Once you are designed into a hyperscaler's infrastructure at this level, you are entrenched. That creates a phenomenal competitive moat.
That leads perfectly into how they're aggressively trying to expand that moat. We need to look at the Celestial AI acquisition. I see terms in their strategy reports like electro-optics and photonic fabrics. Can you translate that jargon into what it actually means for the business trajectory?
Absolutely. Celestial AI specializes in next-generation connectivity. A photonic fabric is essentially a technology that weaves pathways for light directly into the silicon chip itself, rather than just using light for the cables connecting the racks.
Oh, right into the chip.
Right. And electro-optics is the technology that acts as the bridge, converting the electronic thinking of the computer chip into a light signal instantaneously. By acquiring Celestial AI, Marvell is bringing the absolute cutting edge of this light speed transfer under their own roof.
And the financial projections for this acquisition are striking. Celestial AI is targeting $500 million in revenue by fiscal 2028, and they're aiming for $1 billion in annualized revenue by fiscal 2029.
Yes.
And they're operating within an optical market that is estimated to be worth $10 billion overall.
Exactly. Marvell didn't just buy a neat piece of technology, they bought a profound accelerator for their top line. They are positioning themselves to capture a significant percentage of that $10 billion total addressable market.
I also want to touch on some of the more forward-looking, slightly speculative buzz surrounding their tech stack. I've been reading notes about these unconfirmed rumors regarding pivot voltage regulators.
Yes, that is a fascinating development, though we really must emphasize to the listener that it remains speculative at this stage. The industry buzz centers around multi-kilowatt pivot voltage regulators that could hypothetically reduce the energy losses in AI server racks by an incredible 85%.
85% energy loss reduction.
Remember, power consumption is the ultimate governor on AI growth right now. If Marvell has exclusive access to technology that can eliminate 85% of energy waste at the rack level, that fundamentally changes the economics of running a data center.
It goes from being an iterative hardware improvement to an absolute necessity for any competitive cloud provider.
Completely changes the game.
Okay, so let's summarize the picture we've painted so far for the listener. We're looking at a company with 37% revenue growth, a near 60% gross margin, a deep competitive moat that involves physically integrating into the world's largest data centers, and forward-looking acquisitions targeting a $10 billion market.
The stone profile.
Hearing all of that, you would expect their stock chart to look like a straight line pointing up. But here is the disconnect that is confusing so many retail investors. If you pull up Marvell's stock right now, it is down. It's currently hovering around $78. Over the last 90 days, it has dropped 19.3%, and it is down 8.15% over the last year. So what are we missing? How does a company firing on all cylinders lose nearly a fifth of its value in 3 months?
This is where we have to separate microeconomics from macroeconomics. The microeconomics, the fundamental health, revenue, and product line of Marvell are exceptionally strong. But the stock market does not operate in a vacuum.
It never does.
This recent 19.3% drop is directly tied to a broader tech and chip sector sell-off fueled by geopolitical fears. Specifically, the market has been reacting heavily to the Iran crisis.
Let's dig into that because it is crucial for you listening to understand how global events impact your portfolio. How exactly does tension in the Middle East threaten a semiconductor company based in the United States? Are they sourcing rare earth metals directly from Iran, or is this just algorithmic panic selling across the broader market?
It is predominantly the latter, algorithmic panic and institutional de-risking. Whenever there is significant geopolitical tension in regions that could disrupt global energy supplies or shipping lanes, big institutional money pulls out of higher-risk, high-growth sectors like semiconductors.
They flee to safety.
They flee to safe haven assets. The trading algorithms that manage billions of dollars are programmed to sell off high-beta tech hardware stocks when volatility indexes spike. It genuinely does not matter if Marvell is making the best AI interconnects in the world. If the entire semiconductor index gets sold off due to macroeconomic fear, Marvell's stock goes down with the ship.
So we are looking at a classic baby with the bathwater scenario. The stock isn't dropping because hyperscalers stop buying their products. It's dropping because fund managers are trimming their overall tech exposure.
Correct. And for a long-term investor, this is exactly where the wealth-building opportunity potentially presents itself. When a fundamentally sound stock is artificially depressed purely because of macroeconomic panic, that volatility often creates a highly attractive entry point.
The analyst community certainly seems to align with that perspective. Despite the painful 90-day slide, the long-term outlook from Wall Street remains overwhelmingly bullish. We're looking at 30 different analysts who currently maintain a buy consensus on the stock.
That's a strong consensus.
Very strong. Their price targets for the 2026 to 2028 window are sitting between $113.70 and $138. If you calculate that from the current price of around $78, that implies an upside of up to 76%.
And we are also seeing highly constructive sentiment building ahead of their upcoming earnings. Jim Cramer recently weighed in, explicitly calling the stock a buy going into the quarter.
Interesting.
He specifically cited the strong leadership of Marvell's CEO, Matt Murphy, and highlighted those deeply entrenched partnerships with entities like Amazon Web Services. When high-profile commentators signal accumulation ahead of major catalysts, it often builds a floor of psychological support for the stock price.
But to really build smart wealth, you cannot just look at the rosy upside projections. You need the complete objective picture, warts and all. So let's pivot and look closely at the bear case. A 76% potential upside implies there is substantial risk priced in. What could actually derail this growth story?
The single most glaring vulnerability Marvell faces is customer concentration risk. While having the biggest tech companies on Earth as your clients is a distinct advantage, it is also a very sharp, double-edged sword.
How concentrated are we talking?
The data reveals that a staggering 81% of Marvell's total revenue comes from just its top 10 customers. Even more concerning for a risk-averse investor is that their top 2 customers alone account for over 10% of their total revenue.
Wow, that is the metric that keeps a chief financial officer awake at night. So if one of those top 2 hyperscalers decides to pivot their architecture, or if they decide they want to try and build these interconnects entirely in-house to save money, Marvell takes an immediate, direct hit to the balance sheet.
Exactly. We know that companies like Amazon and Google already design some of their own compute chips. If they successfully dedicate their engineering resources to designing their own optical interconnects, Marvell loses a foundational pillar of its revenue.
But are they actually capable of doing that efficiently? Or is the optical intellectual property too complex to replicate quickly?
It is incredibly complex, which is what protects Marvell for now. Building a processor is one thing. Mastering the physics of weaving light into silicon at scale is another.
Right.
But the threat is always looming because hyperscalers have functionally unlimited capital to throw at the problem.
Right.
And furthermore, Marvell is not operating in a vacuum. We have to talk about the fierce competition, particularly from Broadcom.
Right. Broadcom is the absolute heavyweight in the custom networking space. How does Marvell stack up against them right now? Are they operating neck and neck, or is Marvell playing catch-up?
Broadcom is a titan, and they dominate the broader networking landscape. Marvell is a highly aggressive challenger that has carved out specific lucrative niches in high-speed optical and custom compute. But it is a constant arms race.
So they can't rest on their laurels.
Not for a second. To maintain that beautiful 60% gross margin and defend those 18 hyperscaler design wins, Marvell must innovate relentlessly. If their technology slips even half a product generation behind Broadcom, those top customers will not hesitate to jump ship. The switching costs are high, but hyperscalers will pay them if it means gaining an edge in AI speed. Marvell has a wide moat, but they have to spend heavily to defend it every single quarter.
Okay, we have thoroughly mapped out the bull case, the geopolitical macro risks, and the fundamental bear case. Now, let's look at the calendar, because timing your entry is critical. What is on the immediate horizon? What should you, as the listener, be marking on your calendar over the next 3 months?
The most critical immediate catalyst is arriving next week in March 2026. Marvell will be releasing their Q4 fiscal year 2026 earnings report. The consensus expectation on Wall Street is $2.2 billion in revenue, which would represent a 21% year-over-year jump.
Very solid.
The street is heavily anticipating strong beats in both their custom AI silicon and their connectivity divisions.
Beyond just the headline numbers, whether they beat or miss that 2.2 billion mark, what specific commentary should a smart investor be listening for during the management call?
You want to listen closely for 3 distinct updates. First, you need confirmation on their fiscal 2027 guidance. Are they firmly sticking to that $10 billion total revenue target?
Yeah, checking the trajectory.
Second, listen for any language regarding multi-year customer capacity plans. You want verbal confirmation from the CEO that those massive hyperscalers are locked into long-term purchasing agreements, which mitigates that customer concentration risk we discussed.
That's crucial.
And third, listen for any operational milestones regarding the Celestial AI integration. We need to know that the technological merger is moving smoothly and that those future revenue projections for the optical market remain on track.
Excellent breakdown. Okay, let's bring all this information together and summarize the final investment thesis. Taking all of these data points, the financials, the technology, and the market sentiment into account, Marvell Technology earns a highly attractive bullish score of 8 out of 10.
It really does.
You're looking at an AI infrastructure pure play, generating robust free cash flow, enjoying nearly 60% margins, and providing the exact technological solutions that the world's biggest companies are desperate to acquire.
And when you look at this from a wealth-building timeline perspective, there are really 2 distinct ways to position yourself. It is highly viable as a short-term swing trade playing into the momentum of next week's earnings report.
Because of the dip.
Yes, this is especially true given that the recent geopolitical dip has artificially depressed the stock price, creating a potential spring-loaded effect if earnings impress. But frankly, the true power of this asset lies as a multi-year hold through fiscal 2028.
And that longer timeline is where we see the full integration of the broader market, right? I keep seeing the term XPU attach in the long-term projections connected to a $2 billion revenue potential. Before we close, what exactly is the XPU attach segment?
It is a critical concept for the long-term thesis. XPU is an industry catch-all term for any processing unit, whether it's a CPU, a GPU, or a custom tensor processing unit.
Got it.
XPU attach refers to all the supporting custom silicon and optical connections that must be physically attached or paired with every single processor sold. For every expensive AI brain a data center buys, they must attach multiple Marvell components to make it function within the network. Holding through 2028 is how an investor captures the full financial wave of that XPU attach ratio expanding across the global cloud infrastructure.
I love that framework. It really clarifies the scale of the opportunity. Before we wrap up, I want to leave you with a final provocative thought to chew on regarding the broader AI landscape. We spend so much time marveling at how advanced these language models are getting and how powerful the core processors have become.
We do.
But as this technological revolution continues, the sheer processing power of these units is eventually going to hit physical and thermal walls. You can only pack so many microscopic transistors onto a piece of silicon before it literally melts under its own heat.
Very true.
When we reach that physical limitation, the only possible way to make AI smarter is to connect more chips together across wider networks at faster speeds. That eventuality makes data transfer and energy efficiency the two most valuable commodities on Earth. So if Marvell Technology holds the keys to the fastest, most efficient light-speed infrastructure in the digital universe, are the current multi-billion-dollar valuations of these networking giants actually underestimating their true long-term ceiling? It is something to seriously think about the next time you see the stock price dip due to a temporary market panic.
It is a profound question to ponder as we watch this infrastructure supercycle unfold over the next few years.
And that wraps up today's analysis. Thank you for joining us, and we will catch you on the next deep dive into the markets.